So what if I told you the one thing most traders focus on, picking the perfect stock, is actually not the key to making real money in the markets? Today, we're going to tear down one of the biggest myths in trading and build something new, something based on what the pros actually do.
And don't just take my word for it. This comes straight from Deepok, a guy who crushed the US investing championship. He says, our obsession with finding the next big thing, the next hot stock, it's kind of misplaced. The real secret, the engine that drives those massive returns, it's hiding somewhere else entirely.
And why should we listen to this guy? Well, how about this number? 259% in a single year. That kind of return, that's not just luck. No way. That is the result of a system, a finely tuned machine. So what is that system?
Okay, let's get right into it. Section 1, the real key to returns. This is about a fundamental shift in thinking, the kind of shift that really separates the amateurs from the pros who do this consistently. Think about it. You can give the same exact stock tip to 10 different traders, and I guarantee you're going to get 10 completely different results. Why? Because picking the stock, that's just the starting line. The real game is everything that happens after you buy, how you manage it, how you size your position, and most importantly, how you protect your capital. It's not about having a crystal ball, it's about having a rock-solid blueprint.
So, what does that blueprint actually look like? Well, that brings us to Section 2, an expert's 4 pillars. Deepok's entire strategy is built on these 4 foundations. And this isn't just a random list of tips, it's a complete, cohesive system for thinking about risk.
And here they are. First, you gotta know what kind of market you're in. Second, you adjust your position size to match those conditions. Third, you are absolutely ruthless about cutting your losses small. And fourth, the one that ties it all together. You have to know the simple math behind every single trade you make.
And check this out. This timeline from his 2023 championship run shows that first pillar perfectly. Look at how his returns almost perfectly mirrored the market itself. In the choppy beginning of the year, he was flat. When the market took off in the summer, boom, that's where he made his 200+%. And when things corrected in the fall, he protected it all, staying flat. He wasn't trying to fight the market, he was just dancing with it.
So how did he do that? How did he dance with the market? By changing how aggressive he was. That's pillar number 2. See, in a strong uptrend, he was taking big, concentrated bets, 25% of his portfolio, sometimes more. But when the market got tough, he scaled way back to just 5 or 10%. And during a correction, he remembered that cash is a position too. Sometimes the smartest move is to just sit on the sidelines.
Now for pillar number 3, taking small losses. This quote from another trading legend, Mark Minervini, it says it all, doesn't it? A stop loss isn't a sign that you failed. It's your brakes. It's the one thing that guarantees a single bad trade can't blow up your whole account. You'd have to be insane to drive a car without brakes, so why would you ever trade without them?
All right, Section 3. Let's talk about debunking the 2% rule. We know we need to use stops, but this leads us to one of the most common and, honestly, most misunderstood rules in all of trading. We're about to poke a hole in some conventional wisdom here.
You've heard it a million times, right? The 1% rule or the 2% rule. The idea is simple. Never risk more than a tiny, fixed percentage of your accounts on any one trade. And look, it sounds smart, it sounds disciplined, but the truth is, it's dangerously simple.
I love this quote. It's from a quantitative finance pro on Reddit, and it's designed to make you do a double take. Pure trading astrology. What does he mean? He means that picking an arbitrary, fixed number completely ignores the most important variable there is, the trade itself.
And here's the real divide. The retail rule is static. It's a blanket you throw over every single trade, no matter what. The professional reality is totally dynamic. Risk isn't just some fixed rule. It's calculated based on the trade's specific volatility and how it's structured. A pro's total portfolio risk might be 1%, sure, but how they get to that number is a completely different ballgame.
And that brings us right to Section 4, the math of a trade. If a fixed percentage is just astrology, then what's the science? Well, it all comes down to a really practical formula that you can use on every single trade.
This is the concept that changes everything. Position sizing. It's not about how much money you throw at a stock. It's about figuring out how many shares to buy so that the distance from your entry point to your stop loss always equals a specific dollar amount you're willing to risk. This makes the risk on every trade equal, no matter what stock you're buying.
And here's the formula. It's actually super simple. Step 1. Decide how many dollars you're willing to risk.
Let's say it's 1% of a $100,000 account, so that's $1,000. Step 2, look at your chart. What's the risk per share? That's just your entry price minus your stop loss price. And step 3, just divide your account risk by your trade risk. That's it. That number tells you exactly how many shares to buy.
Let's look at a real-world example to make this click. Here, Up will put a 25% position into Palo Alto Networks. That sounds like a big bet. But because his stop loss was super tight, only 4.7% away from his entry, the actual risk to his entire portfolio was just over 1%. See, he could get aggressive with the position size because the trade itself gave him a very low-risk entry.
Okay, this example of a losing trade might be the most powerful one of all. Apple took a massive 75% position in Eli Lilly. That sounds absolutely insane, right? But look at the math. The trade's specific risk was tiny, just 1.3%. So his total portfolio risk was only 1%. He got stopped out, but the loss was small and totally controlled. This is the system working perfectly to protect his money.
And here's one more, NVIDIA, right after a big earnings report. He put on a 50% position on a stock that had just gapped up. Again, sounds crazy, but his stop was just below the low of that day, which means his trade risk was only 1.6%. The final portfolio risk? Less than 1%. This math is what lets you be aggressive when you have high conviction, without ever being reckless with your capital.
Okay, last section. Section 5, Your Risk, Your System. The bottom line, the most crucial point of all this, is that success comes from having a systematic approach. It's not about getting lucky, it's not about being a genius stock picker. It's about discipline and math.
So what did we learn today? First, that managing your risk is way more important than picking the winning stock. Second, that fixed rules like the 2% rule are just too simple for a complex, dynamic market. Third, your position size has to be based on the trade's unique risk, not some generic percentage. And finally, that a winning system isn't about always being right. It's about making sure that when you're wrong, the damage is tiny and completely under your control.
So I want to leave you with a final thought, a little piece of homework. Go back and look at your own trading history. Pull up all your old trades and just ask yourself one question. What if I had a hard rule that no single loss could ever be bigger than, say, 8% or 5%? What would that have done for your bottom line? I think the answer might just change the way you look at trading forever.